Mastermind. This is Inga Springman coming to you today. Scotty is on vacation, so he took the day off to spend it with his family. I have an awesome guest with me today. He's a good friend of mine. His name is David Heilman, and he's going to talk to you all about reverse mortgages and how you can use them for purchases. So listen up. I'm really excited about this class because I have a lot to learn too. Take it over, Dave.
Great. Thank you for having me. I'd also want to thank you and thank Scotty for having me as your guest today. I know we have a lot of people on the call from all over the country, so I do want to just a quick little housekeeping, if you will. I think questions are going to be held for at the end. This presentation will probably be about 30 minutes or so, and then I'll be certainly be happy to field your questions. Also, my contact information is at the end of this. I'm currently a licensed reverse mortgage loan officer in the state of South Carolina, but I have contacts and know people all over the country. So if you're looking for someone in your area that would be interested in finding out more information and working with someone closer to you, certainly just ping me and give me an email, and I'll be happy to point you in the right direction. So I want to give you a quick little background on myself. I've been in the reverse mortgage industry for the last 10 years. In fact, today is my anniversary. I looked down at the calendar and realized I started 10 years ago today in this industry. And I don't come into it from a forward or traditional, I call it forward, traditional mortgage lending world. I worked in healthcare for a number of years. Got very familiar with the demographic that this product serves, and made the transition again 10 years ago today into just focusing on reverse mortgage lending. So again, happy to be with you. Thanks for having me, and I look forward to hopefully educating you all on how you can use this product to make more sales.
Awesome. Thank you, David.
Yeah. All right, let's get it going. And there we go. Okay, so what is a HECM? And you're going to hear me use a couple of terms. You're going to hear HECM, which stands for Home Equity Conversion Mortgage. That's the official name of the reverse mortgage. You can, of course, hear the name reverse mortgage, and then you can hear me sometimes refer to it as H for P, or HECM for purchase, which is really appropriate for the audience. But a reverse mortgage is a unique FHA-insured loan that enables older homeowners, 62 and older, to convert part of the equity in their home into cash without having to sell the home, give up title or ownership to the home, or take on a new monthly mortgage payment. Now this definition is something that the National Reverse Mortgage Lenders Association, which I'm a member of, has put out a number of years ago, and it's a great 101 and a few points of emphasis on this definition. 62 and older, converting a part of the equity in their home into cash, and then of course it's not 100%, so it's a portion, and without having to sell the home, give up title or ownership. That's a big one. This is not the type of loan program that the bank owns your house. You're just using the home as collateral, just like you would with a regular mortgage, but you don't have to make a monthly mortgage payment. Now, you are responsible for property taxes, insurance, and home upkeep, but no requirement to make a monthly mortgage payment. So why is this product important? There's 4 things I've identified as why this product's important. There might be more, but the first one is demographics. Second is longevity. Retirement income sources is the third, and then the home, of course, is, or the perfect home for this aging population, is the fourth. And I'm going to jump into each one of them very briefly, and then we're going to get into the details of the loan product. So demographics. Baby boomers, we've all heard this number before, and there's different numbers out there, but it's roughly, you hear the same thing. It's 10,000 people are turning the age 65 every day in this country for the next 15 years. That is the baby boomers starting to move through the pig through the python kind of scenario. Millennials and boomers will dominate the market for the next 10 years. So, and that came from Realtor.com and their housing, national housing forecast from this year. So clearly demographics are playing a major role into why this product is important. Longevity is different than demographics. Longevity will affect healthcare, housing, retirement, job creation, traffic, entertainment, and just about every other aspect of our society moving forward. We are all living longer. I think it was 1935 is when Social Security was enacted, and you know the average life expectancy in 1935 was age 62. Today, retirement is seen as age probably 65 and even further on. But so our society, we're going to have a societal shift as we continue to live longer, see the baby boomers come through, and we're all living longer. So you can expect to be in retirement for, many people can expect to be in retirement for 30 years.
Wow, that's a long time.
I mentioned, yeah, better have plenty of funds. So I mentioned retirement income sources. This is an interesting graphic here. The one on the left side you can see is among households age 65 to 75 with no retirement savings, and you can kind of see where they're dependent on their source of income. Very heavy Social Security. There is some wages, they're still working. A little bit of a defined benefit plan or a pension plan, those are clearly going away. And then some public assistance. And then if you look at the one on the right, this is with some retirement savings. They're less needed for Social Security income, less dependent on Social Security income. They're still working. 30% age 65 to 74 are still working and dependent on that income from wages. 16% have a defined benefit plan or some sort of pension, and then of course 9% have some retirement plan distributions, retirement savings. What is missing from both of these circles is home, and home equity specifically. So what role is home equity going to play in the retirement income sources? So it's very telling when you see, especially this demographic without retirement savings. This one too, home has a place in both of these. So the home equity, how are we going to use it in retirement? And then the home, the fourth element that is very important is this demographic is downsizing, or we've been told not to use that word anymore. Many of you on the call may realize that, are also trying to change the lingo there. Right sizing. Downsizing assumes or suggests that you're giving something up, and the boomers do not want to be giving anything up. So we change our lingo to right sizing, upsizing to a dream retirement home. Oddly enough, last year, if you look down at the stats here, last year 4.2 million people entered retirement age and moved into a new home. 30% of those moved into a larger retirement home. And I think it's probably that younger age demographic, the 62, 65, that younger boomer who has a lifestyle that they're used to, and maybe they're wanting that dream retirement home. So they're actually upsizing. And then aging in place. The home needs to be suitable for aging in place. And this is going to be certainly more with the older part of the cohort, the boomer cohort going forward. But 90% of seniors want to stay in their own home as they age, often referred to as aging in place. So that's a buzzword now, and you've probably heard that, and that's straight from AARP. So 90% of seniors want to stay in their own home. So how are they going to be able to do that? Okay, so the HECM for purchase, or you can call it a reverse for purchase, or H for P. Maybe you've heard all those. But what it does, it allows an adult 62 and older to buy a home with reverse mortgage loan proceeds. Okay, it allows them to preserve much of their cash assets, and I'll show you some examples here in a minute, for other retirement needs. So instead of having a homeowner or a borrower or a buyer, excuse me, going into a new home and putting all cash into that new home, This allows them to preserve some of that cash assets, and maybe that's all they have. Maybe they need some other retirement savings, and use a portion of cash and a portion of HECM proceeds or reverse mortgage proceeds. And I'm going to illustrate this in a minute and show you some examples. It allows them to relocate closer to family, purchase a single level or more accessible home, right sizing for, and we've mentioned all these, affordable living, less maintenance and upkeep. So the reverse mortgage has some consumer protections. Reverse mortgages are non-recourse loans. Okay, this means that the borrower or the estate will never owe more than the loan balance of the loan balance or the value of the property, whichever is less. Okay, so the way I always say it is you can never owe more than the value of the house. What happens is the funds, the loan grows over time because there are no payments. There's basically a deferred payment until this loan is finally settled. So you have an increasing debt, decreasing equity. The only unknown is home appreciation, but you have an increasing debt. So the loan balance is growing over time. The key with this, reverse mortgages, all of them are FHA insured. The Federal Housing Administration insures these, and that function allows them to be non-recourse, because if you ever owe more than the value of the house, you are not responsible for it. So a quick scenario. A borrower does a reverse for purchase. They live in the home for 20 years, and the loan balance has grown to $300,000, and the home will only sell for $250,000. Both borrowers are deceased. The heirs are now going to settle the estate, and they have a home that's worth $250,000, but a loan balance that is $300,000. There's clearly a $50,000 shortfall there, but the estate, the heirs, other assets are not responsible for that shortfall. The heirs in that case could just choose to sign over the deed in lieu and not even try to sell the home. There's nothing in it for them to sell it. So that function is the non-recourse function. The estate could have $1 million in it. It does not have to pay that $50,000 shortfall. So that's very key with reverse mortgages and how they work. On the reverse side of that, or on the opposite side of that, if the loan balance has grown to $200,000 and the home sells for $300,000 at the end, the heirs sell the property if they choose to give up the property. They sell the property, pay back what was borrowed. The $200 gets paid back, $100 goes to the heirs or the estate. So it protects the heirs there. There is no time limit. There is no term associated with the reverse mortgage, so there isn't a 20-year or 10-year or 5-year term, as long as the homeowner maintains the home as their primary residence, continues to pay the property taxes and insurance, and upkeep of the home. They have no requirement to make a monthly mortgage payment. Now, borrowers are required to attend third-party HUD counseling. The Department of Housing and Urban Development requires this, and they have agencies located all over that do this counseling. It is the only mortgage product where you have to go to counseling and get issued a certificate before you can apply. You can actually apply, but you can't start ordering services. So the reverse mortgage counseling is, again, a very important consumer protection and safeguard. Okay, so you might be asking, who all is eligible? I mentioned the age, 62 or older. They must have a net proceeds from the sale of their previous home or considerable liquid assets to bring to closing in order to make this transaction work. Many cases, they are selling their old home, moving into a new home, and have some net proceeds to put towards this purchase, but they cannot borrow funds, and they can choose to retain their current home if they qualify to maintain both the current home that they're leaving and maybe the new home. So that scenario would be Bob and Mary are moving from North Carolina to South Carolina. They don't want to sell their current home. It's free and clear. They have liquid assets. They're going to rent out the home in North Carolina. They have liquid assets to do a reverse for purchase on a home in South Carolina. They can retain their previous home Just their primary residence has to be the one in South Carolina, and they must qualify for property taxes, insurance, and upkeep, basically maintenance, be able to qualify for both homes. The cost of property charges. So again, must be your primary residence, must meet minimum FHA property standards. Again, this is an FHA insured loan, so it does have to follow the FHA guidelines. They must occupy the property within 60 days, and I just mentioned the mandatory counseling session.
Interesting.
The kind of property types that this can be done on, it'd be a single family home, that's usually what it is, 2 to 4 unit properties as long as you're remaining in one of them, of course, as your primary. Townhomes, FHA approved condos, which is very difficult, but nonetheless it can be done if it's approved, FHA approved. Newly constructed properties must have a certificate of occupancy. This is a big sticking point with new construction and something our industry is trying to address and get changed. FHA sees it as this loan can only be done on existing properties, therefore they want to see a CO before you can even start the application. So definitely some education needed here. Doesn't mean it can't be done with new construction. It just means educating, getting with a good lender, educating the builder in many cases, the consumer, of course, on the process. It's a little bit more lengthy, but nonetheless it can be done, and certainly many lenders are doing new construction reverse for purchases. Ineligible properties, co-ops, bed and breakfast or boarding houses, any kind of commercial property. So it's got to be, again, primary residence. Okay, so how much does your client qualify for? A lot of question I get a lot of times, and many of you are probably thinking, how do I know how much my client would qualify for? Well, there's 3 factors: age, maximum claim amount or appraised value, and we'll get into that in here in a minute, or sales contract, and interest rate. So age, maximum claim amount, interest rate. Age is, the older you are, the more loan to value. And I have a matrix I'll share with you here in just a minute. The minimum age being 62. There is no real maximum age. You can be 92, 102, whatever the number is, and do a reverse mortgage. So age, 62 is the youngest age. MCA, or maximum claim amount. Okay, this is the lesser of the appraised value, the sales price, or the FHA HECM lending limit. They call it a lending limit. It's really a value limit. I hate the word lending limit, but that's what they use. It's really a value limit. So right now that FHA limit, MCA, is $636,150. So if you have a buyer who's looking to buy a $700,000 home, the value that will be given, or the factors that go into how much they qualify for, we first have to then use $636,150, their age, and then the interest rate to generate how much they qualify for. So, and then interest rates, there are fixed and adjustable. Many of the purchase products are a fixed rate right now, but there are strategies for an adjustable rate purchase product. And I don't know if we'll have details or time to go into the details of that, but anyway, there's fixed and adjustable, different strategies, excuse me, different strategies for both. Okay, so here's the matrix I was talking about. And roughly, a rule of thumb is if you're age 62, you're going to qualify for about 50% reverse mortgage proceeds applied towards the purchase and 50% cash. The two come together and complete the purchase. 85, you're going to qualify for roughly 65% reverse mortgage proceeds, and you only need 35% cash. So think of it as if you have a 62-year-old looking to purchase a home, they can get into that home for 50% cash, 50% loan, and no requirement to make a monthly mortgage payment. And this matrix, again, home values here at the top, age going down this axis, and you can see this is roughly the amount that they would qualify for. So a 74-year-old trying to purchase a $400,000 house would qualify for roughly $227,000 to be applied to the purchase. The remaining cash needed would be, the remaining needed would be cash. Okay, so what if the home needs some repairs? Well, FHA has some sticklers with this. Health, safety, or certainly structural integrity. That's probably any loan or any lender, but health and safety, peeling paint, little nitpicky things, but repairs do come up either on the home inspection or the appraisal. Both have to be reviewed by an underwriter. They must be completed prior to closing by the seller. There is no escrow for repairs. There is no set aside after closing repairs, nothing like that on the purchase. All have to be done prior to closing, and they have to be done by the seller. There are no credits or seller concessions or discounts given or monies given towards repairs from the seller. The seller has to complete them prior to closing. And then, of course, included in the purchase agreement as an addendum and agreed by all parties. Again, buyer cannot pay any money into the repairs before they own the home. So the seller must complete all the repairs. So as a realtor, writing an offer with a reverse, what do you need to know? And there's, some of these are some of the things that we always advise the realtors we work with. Contracts, please just make them for 45 days. I know a lot of people like a 30-day offer. They like to make their offer as strong as they can. I get that, but these need to be, they can take a little bit longer, and rather than us having to go back and forth and get things signed or re-executed, it's better just to everybody agree on a 45-day closing, and I even like to see another 10-day extension in there. Be sure to put FHA reverse. There is on many contracts, there's a place for FHA, and then maybe write reverse in there, or other write FHA reverse, but the type of financing would be an FHA reverse. Must have a fully executed, certified and true, or original contract. Now, the original contract, that's not going to happen. I get that. It rarely does. I literally have a certified true stamp sitting in my office desk, and when I know that all the documents have come over, I verify with the agent, that the realtor, that this is in fact a certified and true copy, and then I stamp it certified true. But many investors in our industry want to see a certified true copy or an original contract. There must include an FHA amendatory clause with the contract, and what's most important here is it must be dated the same date as the contract. Many times this document comes, it's a trailing document. You might not have access to this document, or you might not know to throw it in when you're getting all the contracts signed. But the FHA amendatory clause or escape clause, which basically allows the buyer the opportunity to cancel the transaction, to back out of the transaction without any penalty if it doesn't appraise for enough, or if the seller does not meet the FHA requirements as far as the property condition, and they just don't want to complete the any repairs or things of that nature. So it's an escape clause that allows them to get out of the contract without any harm. It must be signed and part of the contract and dated the same date. Seller cannot pay any closing costs, even if they're customary for the market. So that's a big one. Again, it's another kind of like the CO thing, certificate of occupancy. Our industry is working with HUD and FHA to get this changed, but right now there are no seller concessions, period. No warranties, nothing of value thrown in like a TV or anything like that. Just leave it out of the contract. The seller and the buyer just need to come to an agreement on a price, and that's it. No other seller concessions. We've mentioned this before, but the seller must pay all repairs prior to closing, and all repairs must be on the addendum and then re-inspected, so getting a final sign-off on those. And I've already mentioned the new construction must have a certificate of occupancy. Okay, so as a realtor, what's the opportunity? The opportunity is obviously more sales and growing your business, but because, there's 10,000 baby boomers turning 62 or 65, the numbers change, every day. So people are entering this market every day at a rate of 10,000. This gives you access to a new market. Maybe you're currently not, maybe you find yourself working more with the millennials or first-time home buyers, but you really, really enjoy working with this demographic and you want to break in and do something. Obviously, there is a senior real estate specialist designation, which many of you, I'm sure, are familiar with, and many of you may have. So access to the new market, and I will say that senior real estate specialist designation, they teach the reverse mortgage product in that designation or in applying for that designation. The market is virtually untapped. Reverse mortgages are very much unused, are underutilized at this point. So it's a big market out there. It's just educating the consumer, letting them know that this product is available, and then it opens you up into more choices, more home choices. Case in point, allows you to sell homes at higher prices, more purchasing power. Somebody might come to you with a budget, we can only spend $200,000. Well, with this product, they can probably spend $400,000. If they have $200,000, if their goal is not to have a mortgage payment and all they have is $200,000, if they knew about this product, it could really open their market into looking at more homes. Again, using that 50% rule. If they had $200,000 cash, they could purchase close to a $400,000 home with this product. List homes they are selling. This is an opportunity. If you present this information to a prospective buyer and maybe they don't have an agent yet, or maybe they're thinking about selling their current residence. So this is the potential for 2 transactions for you. And this is a big one. Move current listings faster by lowering the listing price. We have seen many times that sellers have an unrealistic expectation of what they're going to sell their house for, or they need those dollars, they think they need every one of those dollars in order to get in the next home that they really have their eye on. So knowing this product and presenting this product will allow you to show them how they can lower their listing price on their existing home, get the home sold, and then get into their new home, because clearly they don't need as much cash assets as they think they need to get into the home that they want. And then there's an opportunity too with traditional financing. Those that are looking at traditional financing but may not qualify for income or even credit purposes, presenting this as an option, because we do not have to show their ability to repay this loan. Now, we do have what's called financial assessment. That is financial underwriting for income and credit. The income, there is a minimum residual income we must show for the borrowers. So we take all their incomes, we take their expenses, and then of course they don't have a monthly mortgage payment, so we don't have to count that against them as expenses. But we do have to show they have a residual income based on the number of people in the household. And then as far as credit, we don't look at a minimum credit score. We look at how many 30, 60, 90-day lates on any revolving or installment accounts. And if there were, what happened? What was the reason? So here is an example of right sizing. Notice I didn't say downsizing, right sizing. So they're going to a smaller house. Their current home, they might, let's say they have a net gain of $400,000. They're going to purchase their new home for $300,000. This borrower clearly could pay cash for this property and not have a monthly mortgage payment. But they just put all their cash assets. This $400,000 might be all they have really for retirement needs. So they put their $400,000, or excuse me, they put $150,000 into this new home. They bring, or we bring, or a lender brings $150,000 from HECM proceeds, and what that does for them, the net effect, they just put $250,000 cash remaining in other retirement needs. So again, they get the home that they wanted, they're right sizing, and they're preserving other assets for retirement, which, as we already talked about, could be for another 30 years. upsizing, and this is one we're seeing a little bit more of. Maybe they have a net sale gain from the sale of their current home of $200,000, and they go and purchase a new home for $300,000. Well, a couple of things here. If they were doing this, they would either need to, if they did it without a reverse, right, they would need to come up with $100,000 more, or traditional financing, which has a monthly mortgage payment. But here, they're able to only use a portion, almost all of it, but $150,000 was needed from the sale of their old home, meaning they put $50,000 somewhere else for other retirement needs. Brought $150,000 cash, $150,000 came from the reverse mortgage lender to purchase their new $300,000 home. Again, no requirement to make a monthly mortgage payment as long as they continue to pay property taxes and insurance and HOA dues and general upkeep of the home. All right, here's my information. That was a crash course, a little 30 minutes. I certainly want to take time for some Q&A. I'm sure there are some questions out there. This is my contact information. I am a member, as I mentioned at the beginning, of Reverse Mortgage Lenders Association. On that website, it's reversemortgage.org. If you want to look it up for yourself, reversemortgage.org. And you can locate a lender on that as well. That's a very good source for locating a lender in your area. I think it does it by state or even by zip code. But I highly recommend working with a lender that specializes in reverse mortgages, especially with the reverse for purchase product. I did not go into the traditional reverse mortgage. I just wanted to present the purchase to you today. A traditional reverse mortgage is just a refinance of an existing home, but all these numbers and scenarios kind of work the same, or how much they qualify for, it all works the same. Qualifications are the same, eligibility is the same, property types is the same, all that's pretty much the same. So a traditional reverse mortgage, just real quickly, as I mentioned, is a refinance of your existing home. So again, age 62, minimum age, allows them to access a portion of their home equity to maybe establish a line of credit, pay off an existing mortgage to free up monthly cash flow, or a variety of other needs. But I did want to focus this presentation, knowing the audience, on the purchase product. And also, I'll wrap this up and then take questions. I teach, just to give you an idea of how in-depth you can go into this, I teach a 4-hour CE in the state of South Carolina for realtors. So y'all just got it, the crash course in 30 minutes. So it's a little bit like drinking from a fire hose, but I'll be happy to take any questions.
Yeah, that was great, Dave. Thank you so much. That was a lot of information, and you're right, it was jam-packed. And like I'm a complete newbie here, so I just wanted to listen, so I didn't interject at all. But I do have some questions from the audience, and I appreciate you guys all coming on. We had a good group today. Susan, is that Suzanne or Susan, wants to know, would this reverse mortgage info apply to Canada?
No, this is an FHA, no and yes. Canada has their own reverse mortgage program, and many countries have, actually Canada is one of them. They were just recently in the news how wildly successful the reverse mortgage is becoming in Canada and widely accepted. So interesting question, but no, this is strictly for U.S. properties.
Okay, so what would a Canadian realtor or a Canadian loan officer need to do? Is there somewhere that they can go look it up, or is there a .org site for Canadian?
Google.
Google. Okay.
Yeah, that's where I would go immediately is Google. But I have no idea, what lenders or players in, what the industry, frankly, what the industry looks like in Canada for this product. Other than I just recently read an article about how it's widely, becoming accepted and widely used.
Awesome, thank you. And Brent has a question. Are heirs still allowed to redeem the home for 80% of market value once the owners have passed away?
It's actually 95%, but yes.
Even better.
Yeah, so heirs can retain the properties or the property once the borrowers have passed. They have, what happens is at the end is the heirs have 6 months with 2 90-day extensions with HUD to either sell the property or refinance the property or pay it off with other assets. So if the heirs want to retain the property and mom or dad left enough assets, then they can just turn around and pay off the loan, what was borrowed plus interest, and retain the property or retain title to the property. Now it's free and clear. Or the heirs can qualify for their own loan and pay off mom and dad's reverse mortgage and make monthly payments. So refinancing. So yes, they can retain the property. It's not the banks. It doesn't immediately go over. But I will say most servicers in the industry want to know the heirs' intentions within 30 days. So it's a very quick kind of timeline, so the heirs need to be aware and know how to respond. But bottom line is, after they notify the lender of their intent, whether it's to refinance, sell, pay it off with other assets, they then have 6 months. Usually 6 months is what it requires.
Now, on that interest, they can't. It's not tax deductible, obviously. That interest that accrued.
Correct, unless you have a borrower that decides they're going to make monthly payments. So if you make monthly payments or maybe make quarterly payments, and this is becoming a little bit more of a strategy in our industry, but those that decide they want to do the reverse mortgage and make payments, it's almost like pick a payment. I want my $300,000 house. I'm going to put my 50% down, but I'm going to make a $500 a month payment. If you're any payments that go, there is no prepayment penalty, and you can make a payment on a reverse, but any payments that then go towards the interest, you would get an interest deduction or the ability to do the deduction at the end of the year.
Okay, awesome. Now, I don't know if you already answered this. I think you did. Can they do a reverse mortgage on the first home that is free and clear, take the proceeds of the first home to use for a down payment on a second home, and do a reverse mortgage on the second mortgage? Deborah wants to know.
No, because you cannot have any borrowed funds. Now, what you could do in that scenario, and I've had a client do this before, primary residence got to remain, where you have the reverse has to be your primary residence. Okay, so you have a primary residence, you're already in your home, it's free and clear, and you want to access $200,000 to purchase a mountain house or a cabin or a place in the mountains or whatever the case may be. So you could do that. You could take the reverse mortgage proceeds, whatever you qualify for. Now, there are some limits on how much you can take in the first 12 months, but there is no strings attached to the funds. So if you had your primary residence, you basically did a refinance, accessed reverse mortgage proceeds, you then took those proceeds and purchased a new home or a second home, whatever the case may be. As long as the reverse, where you did the reverse, remains your primary residence, that is fine. We have any more questions?
Oh, sorry about that. Yeah, absolutely. So I have, Tracy just wants to clarify, so the home they buy must be bought in cash.
50% cash, 50% financed with the reverse mortgage. And that's the minimum age is 62, so I always say 50%. So it's going to be somewhere between 50 and 30% cash, and the remaining, wherever they fall because it's age-based, would be reverse mortgage proceeds.
Okay, great. And Susan would like to know, what if they're staying in their current home and need money for repairs? Where do they get that money?
Yeah, that would just be a regular, traditional reverse mortgage, and it's a refinance. But if the repairs are structural in nature, then they're going to be required to be done prior to closing, even on that transaction. But if they have minor repairs, or they're really wanting to do the reverse so they can fix the home up or modify it, then they can do a set aside for a set aside for repairs. So if the appraisal came back, for instance, and said, had listed, 5 or 6 items that had to be done in order to get the home up to FHA guidelines, but the borrowers had enough proceeds or qualified for enough proceeds, they could go get repair estimates and then do a set aside for those funds and then pay the contractors from the reverse mortgage proceeds to complete the repairs.
Okay, great. Thank you. Tracy wants to know, so the program requires you to have already entered into a reverse mortgage situation and plan to sell that property and use the proceeds for a new property using the reverse for purchase loan product?
No, keep in mind, the purchase is on the new home, okay? The new home is what the reverse mortgage proceeds are going to. So basically, and maybe this is a good way to explain it. In the past, if somebody wanted to do this, they would have to sell their current home, buy their new home, if they want to do reverse, and then wait 12 months and refinance. Okay, so that was the old way, and you just created 2 transactions. Well, that drives up the cost. So HUD said, why can't the senior who is selling their current home or has cash assets, let's just call it cash assets, regardless of where it comes from, they want to buy a new home, why can't they apply the reverse mortgage to the new home? So think of it in terms of what you qualify for is all based on that new home. And I can go back to my scenario here. This is the new home. Okay, the reverse mortgage is not on the reverse mortgage is not on the home they're selling. Their new home is where the reverse mortgage goes. This home is sold. Okay, so their new home, the reverse mortgage gets applied, 150 reverse mortgage proceeds, 150 cash gets them their $300,000 home. So I hope that makes sense.
Okay. Yep, that makes sense. Dwayne has left, but he had a good question. Now, as a realtor or even a loan officer, are there strategies that have been, that you found that's successful in getting the public's attention for this purchase option?
Yeah, I mean, where I've really seen it is when the sales agent, in this case it was actually a builder where I saw my biggest success with this product, and this is personally, there's other success stories, but it always comes back to the realtor presenting this. They don't know about it. Consumers don't know about it. They might know about a traditional reverse mortgage, but and then they've seen the commercials and all that, and they think that it's a loan of last resort and all these different perceptions. But when they see the purchasing power that this product can give them, when they see that they can get into their new retirement home without a monthly mortgage payment, it really opens their eyes. And this is the sleeping giant, so to speak, in our industry. Many people believe that, and I see it on their faces. I mean, if you present this information or show them how this product works, their eyes light up, because many times they've already sold, the old house they sold was the one where they raised their kids, where they had all these memories and they had all these ties. This new home, they don't have as much emotional attachment to it in many cases. And leveraging their assets correctly in retirement in this new home makes all the sense in the world for many. This isn't for everybody, certainly. It's not for everybody 62 or older. If it were, we'd have a lot more people doing it. But a lot of people don't know about it. So I would say from a realtor perspective, if a realtor can get together with a good reverse mortgage lender in their area, in their service area, and really understand this product, you have the potential to really get more sales, higher sales, and help your client not just buy a new home, but set themselves up for a better retirement.
So here, following that up, David, Holly wants to know, what is the downside? Why wouldn't everyone over 62 do this? So that they don't have a mortgage? Are we missing something here? Is that age bracket missing something also?
No, that's so funny. I get that question all the time, a lot of times from the consumer themselves. After they hear it, the first problem is there's so much misconception out there or misinformation about how the product works. Okay, so explaining the FHA's role, the FHA insurance, and the non-recourse feature is very important because a lot of people assume the downside is, oh well, if I do that loan, then the bank owns the house and I have no control. I can't get out of it. All those things. Couldn't be further from the truth. Title ownership never changes. So a lot of it's education, but I do come into three reasons why not to do it. And they're going to be obvious, but I tell people this all the time. They say, why shouldn't we do this? First one, if it's your primary goal to leave your house free and clear to your heirs, this is not for you. This does not accomplish that. If it's your primary goal to leave your house free and clear to your heirs, don't do this product. This does not accomplish that. So I say that very plainly, and it's very obvious to them, but they need to hear it. So that's one. Two is the home really should be a final home, in my opinion. This, especially if you do this product, this should be a home that you're going to live in. This should be your final purchase, your final mortgage even, should be doing this product. And then if you're going to end up moving, you know, if this is a short-term goal, short-term 2-year, 3-year plan, I'd usually say not good. This should be a long-term final purchase. And then the other one, because it's an expensive transaction, the other one is if it doesn't give you peace of mind, if it keeps you up at night, if you're worried about this mortgage accumulating interest over time and growing, then this isn't for you. This is designed to give you peace of mind and financial relief and allow you to have a better retirement. If it does not do that, or if you can't come to that, then don't do the product. I don't want you as a client. At least that's me. So those are the three.
Yeah, those are great. Alex wants to know, can a homeowner buy a triplex, rent the other 2 units out, and collect rent money?
That's a sticky one. No. Yes and no. I would have to, there's different overlays for different investors on that one. So I think as long as, it depends on the investor. So I think rental income from that, if it's a long-term rental, there's all kinds of things you can go there. It can't be short-term rental. I know for sure that, you know, Airbnb, anything like that, I know for sure it can't be short-term rental. But there are some that might have long-term rentals, and then some might require or want the rent to then go pay back the mortgage. So if I had somebody come to me with that scenario, I would say no. This is just your primary residence with this product. We really honestly don't see many 2 to 4 unit properties doing this.
Okay, good question. Now, this is a question from Bill. He wants to know, he must be in Florida. Is the FHA reviewing the policy regarding condos, which is the type of housing many retirees are looking to do, especially, you know, in coming to Florida and down south? What do you think the time frame on that is?
We keep hearing things that, you know, they're going to go back to spot condo approvals, and if you're in lending or if you're familiar with that, that's basically, it was a case-by-case approval process. Probably not as lenient as it was at one point, but first of all, finding a condo that's FHA approved is, you know, finding a needle in a haystack. We've even worked with associations to get them approved, so that, I mean, showing the value of having, you know, not only this product, but first-time home buyers. You know, an FHA approval allows for first-time home buyers and certainly our demographic with this product to purchase condos. But that's a big one, especially when you think about people looking to downsize. This one right here. I mean, a lot of times they want to downsize into a condo with less maintenance, something they can lock it up and leave for 2 months, you know, and travel or whatever. So there's so many reasons why the condo is appealing. Right now, it's hard to do this product on condos unless it is FHA approved. All that being said, the industry, our industry, the Reverse Mortgage Lenders Association, is really pushing for some changes. FHA in general is pushing for changes, or the industry is pushing FHA for changes to the condo approval process. So hopefully more to come on that, and I would hope this year. We were told first quarter, and first quarter is almost over. We would hear something, so I haven't heard anything.
Okay, good to know. Now Eva has a scenario, and okay, so maybe you can play this out for me.
All right.
What about if a person has reverse mortgage in Texas and needs to sell the property and buys in Maryland? The existing home value is $130,000 and reverse mortgage loan is $80,000. What about if the person has reverse mortgage in Texas? Okay, that's what she wants to know. That's the question.
Right. I've actually had this happen a couple of times where people, one was in California, they had a reverse mortgage on their existing home in California, moving to South Carolina. So prime example, they sold their current residence. Now here's the catch, you cannot have two FHA mortgages at the same time. So you can get in contract on your new home, but it has to be, of course, pending on the sale of the old home, which had the FHA reverse mortgage on it. If the net proceeds from that scenario, if it's $130,000 and they owe 80, so they're going to have 50 less fees, so whatever that net proceeds is, they can take those funds along with any other cash assets and purchase their new home in Maryland with the reverse for purchase product. The timing is the only thing there. It's usually about a week lag in between the sale or the final closeout of the home that had the existing mortgage, reverse mortgage, to when you can close on the new one. So you're not going to have simultaneous closings. You're not going to have them within a day. You're probably not going to have them within 2 days. I would prep the client for a week in between the closings so that FHA case number can be finalized and closed out on the old home, and then the new one can be active.
Okay, thank you. Donna had a question. This is a good question. She wants to know, would it be a good idea for reverse mortgage purchasers or traditional mortgage purchasers to buy a term life insurance policy to cover the loan amount in the event of their death so that their heirs don't have anything to worry about in obtaining the funds to pay that reverse mortgage off if they want to keep the property?
Sure. I mean, I guess you can make the same argument, and I think she was saying it for traditional mortgage. I mean, if mom or dad have a traditional mortgage of $150 on their $300,000 house and they pass, the heir's going to have to sell or pay back that mortgage too. So the only thing with life insurance, I don't really recommend it that much. I mean, there's health underwriting and things of that nature, and you're dealing with a demographic that's, life insurance is much cheaper at age 30, 40, even 50 than 65, say. So I don't really see that very often. I mean, it can work, or if they already have life insurance in place, certainly those assets can be applied to paying off the reverse mortgage. So really depends, but I don't see that. I don't see people going out and getting life insurance in order to pay off a reverse mortgage.
Okay, understood. Now this is an interesting question. Carrie wants to know, what if weather does not permit repairs? Like you've got a roof situation and you're under contract and the sellers just can't repair it because of weather. What happens then?
Wait until a sunny day. I mean, it's not, it's not.
It has to be done, right?
Yeah, it's going to have to be done. It delay the closing, whatever, yeah.
Okay, understood. That's why you put 45 days, right, for the most part?
Yeah, you never know.
Sure
you get thrown curveballs, and as realtors know and lenders know, curveballs happen all the time.
Okay, very interesting. So here's a question from James. So the buyer can finance into the reverse mortgage amount the cost of repairs, or no?
No.
Okay, those all need to be done.
Correct.
Prior, unless they're in their regular home, right? And they want to do a standard reverse.
Correct.
Okay.
Now on the purchase
that
though, it's not going to be like if there's things they want to do to the home that are cosmetic and things of that nature, that's fine. They can do those, but they can't be, no escrow or paid into, you can do that after they get ownership of the home. But the repairs that are going to be required with this product are going to be either on the appraisal or the home inspection. And they're going to usually be health, safety, or structural.
Okay. We only have a few more minutes, so I'm just going to get the last couple questions in. Okay. This is from Kathy. Kathy, thank you for asking. She asked, can you actually build a home with a reverse mortgage, or does it have to be already a standing structure that you buy?
You can do. You can build a home. It would be considered new construction. So yes, it just has to be on the builder's line, or whoever's financing the building. Many builders have lines that they're building homes on. This is where the education piece with this product and builders is crucial. I've literally had to get on the phone with owners of builders because they have a timetable, and they have their line, and they need to have this home completed by X, and it's going to close 2 days later with traditional financing. Well, with the reverse, it's going to be 2 weeks, 3 weeks later after CO is issued. And so there's a lot of education there. It doesn't mean it can't be done. One of my most successful stints, I guess, with this product and relationships was with a builder that got it. They built homes that were aging in place conducive homes, and they just knew going into each one that it was going to be 30 days before we would have a closing, 30 days after CO. So the key there is certificate of occupancy has to be issued prior to even applying for the loan. Now we can do everything we can do to pre-qualify these folks, and a lot of times it's it's making sure they have the cash assets to complete the purchase. So it's fairly basic in terms of approval. Of course, running credit and making sure they have the income, but it does just a time-wise requires us to start, or any lender to start the process after CO is issued. The application, the appraisals then ordered, all those things. Now I will say with builders, they love to get COs issued because they know somebody or whatever at the county, and that CO gets issued, and then the appraiser goes out and there's not flooring down in the living room. So it's got to be a completed house. It can't, CO is good to have, but when the appraiser goes out, that house better be completed.
Last question. This is from Alex. He focuses on probate listings in California. How can he find out when the reverse mortgage is terminated upon a client's death? Is there a way to know?
Good question. No, there's no real. I mean, that could drag on because I mentioned before, the heirs have 6 months and 2 90-day extensions. And then if you have a file that's in probate, I know probate can take 8 months here in the state of South Carolina. So, I mean, that's a lengthy process. So I don't know exactly how you could find out when, other than having access to FHA Connection, and most realtors don't have access to FHA Connection, which is, kind of the internal workings of FHA. But yeah, sorry, I wouldn't even know really where to start there. It can just be lengthy, certainly with both probate and the time frame of settling a reverse mortgage.
Awesome information, Dave. That was a whole bunch of great stuff in less than an hour, actually. So I really appreciate having you on today. And just a little housekeeping, that all of the slides will be available tomorrow sometime in the afternoon along with this presentation. If you want to share it with your office, or if you want to share it with your other realtor partners and friends, go ahead and get the link for that from your loan officer. Another thing is that we do have some Canadian specialists in our group, so please feel free just to post that you want more information from a Canadian reverse mortgage specialist, and they will get back to you. I would post that in the Agent Mastermind group. And finally, another thing, thank you again. That was awesome information. Great job, David, and I really appreciate having you on. Thank you, everyone, for attending.
Thank you.
And we'll see you guys next week on the web. Take care.